Hello everyone, this is Terry with Futures.io, and as always, I would like to thank you for joining us today. It is my pleasure to welcome back Peter Davies from Jigsaw Trading for today's webinar, How to Succeed in Trading. Throughout the webinar, if you have any questions, please feel free to type them into the questions box. We'll do our best to answer them at the end of the event. This webinar will be recorded and posted on the Futures.io website within 24 to 48 hours. If you're watching this afterwards on YouTube, please do us a favor and give us a thumbs up if you enjoy it. And as always, please feel free to share, comment, subscribe to our channel. It really helps us a lot. For trading news, events, and information, follow us on Facebook, YouTube, and Twitter using @Futures.io. And now, without further delay, I'll hand it over to Pete, and you'll get the pop-up to share your screen again.
Okay, give me 1 second to do that.
Hi.
Okay, you should see that.
Yep, looking good. She's all yours.
Okay, right, thanks Terry, and thanks everybody for joining today. I hope you're all well. So for those that don't know, my name is Peter Davies. I've been in the trading game since the mid-2000s. Not coincidentally, that was just after my financial advisors managed to lose 30% of my net worth. And at that point, basically, I decided to take over from them, basically figuring that even if I lost money, I would actually still save on the fees. Now at the time, I was regularly attending networking events in Singapore. And there were always a lot of people from banking and the proprietary trading world, people I really didn't talk to when I first met them and I didn't have an interest in trading. And these are people that, spent their time at desks like this all day, doing things that you can do at home, but also a lot of people doing things that we could never do at home, like, writing massive barrier options for Forex. Anyway, once I decided that I wanted to look at this a little more closely, I started engaging with these traders to find out what it was they really did. Now, at the time, I didn't realize how lucky I was compared to most traders trying to pick up trading skills that I actually had exposure to these people. Now, even luckier, as I kept those contacts in the professional world, now many of them have become friends, some are even customers. And I talk to traders every day. I see them fail and I see them do well. And today we're going to take a look at what makes some of the traders successful, what makes some of the traders fail, and what helped those move from failure to success. Now, what I'm also going to do, and I would ask you to do as well, is go through this without jumping to conclusions. So, for example, I could hand on heart say that most of the successful traders I know have got dark hair, and that is absolutely true. That doesn't mean it's a factor in their success. So I don't want to hear that everybody dyed their hair black after this webinar. So some things that you see traders do are going to be very obvious factors in their success, but some things are going to be borderline, right? And in the case where things that are borderline, I will say so and leave you to just draw your own opinion on whether that is really an impactful factor. Now, before we talk about success as a trader, let's just clear up what we mean by traders, because there's a lot of people in the industry that trade, and some of what they do is not available to you or me. So I'll give you a few examples. And the most obvious example that everybody knows about is floor traders, right? Who are really pretty much dinosaurs by now. But if you think about the structure of the old floor, if you've ever seen a picture of the CME floor, it was a bit like a miniature gladiator stadium. So you had the bottom floor, and then around that in a circle or a horseshoe, there were kind of steps up that people could stand on, and the top step was considered the best place because from there you could see everybody in the pit, and that gave you an advantage, as did being tall, because the taller you were, the more people you could see. So the game they were playing in the pits was mostly to take big orders from large firms who wanted a guaranteed price, and they were willing to pay a few ticks to do that. So they'd take that big order and then they'd lay that off against another market like the minis over time. Now, that's not all they did, but that's mostly what they did. Now, that's not something you could do at home, because big firms aren't coming to your house with orders to lay off, obviously. And for a lot of those pits, it was a big macho alpha male game. Now, perhaps the opposite of that kind of trader, but also something we can't do at home, was a very bright guy I met that retired at 35 years old after heading up an FX options team at Royal Bank of Scotland in Singapore. Now, among other things, they were doing things like writing massive barrier options for Forex. Now, what a difference between your typical very outgoing floor trader. You meet a floor trader, they're very loud, they're very outgoing, they tend to swear a lot, right? Very different from this guy, very quiet, very unassuming. For a start, he had a degree in maths. No shock that anybody who works in options, especially making option markets, they need very good math skills. So he's a very quiet, unassuming guy. He wasn't a macho man. I haven't asked him about this, but I should. But, you know, you look at him and you think, you know, yeah, I'm sure when he was at school, he was more likely to have been on the chess team than the rugby team. Now, another trader I know with completely different skills was also a market maker, but he's doing market making, and I'm not sure if he's still doing this now, but basically via an open outcry system in Asia. So basically what he's doing, he's hooked up all day on a squawk to a number of banks dealing with one specific Forex pair, right? Now, they were the biggest outfit doing this. So he was what more you'd call, in England, we'd call him a wheeler dealer, a Cockney barrow boy, somebody very savvy and kind of the, you know, the fake it till you make it type. Because if there was no interest in the markets, he would literally make it up, right? So a big part of his job was pretending there was interest in the markets when there wasn't, to encourage the banks to trade. So his biggest assets for that job were his charm and his wit, right? So this was the kind of guy, you meet him, everybody loved him, right? You'd see him in the middle of a party, everybody would be gathered around him. People instantly liked him. That was his edge. Now, are these people traders? Absolutely. Are they doing stuff that you couldn't do at home? Absolutely, yes. But there are things you can learn from people like this about, first of all, about the way the game is played in different areas, about what moves the markets, about what causes people to engage, also about the different personality types. So the guy at Royal Bank of Scotland doing the options could not have run the open outcry system. He just didn't have that kind of outgoing personality. Now, as a screen trader, you don't fit in any of those models. But just like those obviously disparate roles, there's different types of home trading too, with different skills and different personalities required. Well, why is that important? Well, one of the reasons that's important is because we're all wired so differently. Now, a friend of mine used to work for a really, really gifted trader. So this guy in his early 20s had managed to amass about $15 million, and he did that with a combination of borrowed money and what would best be called very good intel, you know, the sort of thing that Martha Stewart would be proud of. He then ended up working or trading for a boutique hedge firm. And what they would do, basically, the boutique hedge firm, they would give traders money, right? And in this case, they gave him $30 million. And he would do what a lot of equities day traders try to do today, and it's a valid technique. You look at earnings announcements, news, he had his own stock scanners developed to figure out which stocks were in play and then trading them. Difference between him and the man at home, though, is he would have 4 full-time researchers that would not only tell him what was in play for that day, but they'd also tell him what the reaction was to similar events in that stock the last time round. So what you'll find is that some companies regularly underestimate their earnings so that when the earnings come out, they can say beat estimate, right? So some companies just do that as like a standard thing, come in above expectations, and then the stock tends to react to it in a certain way. And they would know all of this about every earning stock every day. Great stuff, very regular, 6-figure days. And you would think the trader trading this would be happy. But if the researchers missed just one opportunity, this guy would go nuts, okay? So if he saw something take off and he wasn't part of it, he'd go and look at it. And if he thought one of his researchers should have spotted it, he would shout at them sometimes for an hour, right? And in that hour, he would miss lots of other opportunities, okay? And it's one of the reasons he had a high turnover in researchers. It was totally unnecessary. It was just the way he was. He might have been bipolar. He might have just been a bit of an a-hole, but that's just the way he operated. On the other hand, what he didn't do when he was like that, he never once took it out on the market, okay? He didn't chase trade. He didn't revenge trade. He just shouted at some guy earning 100th of what he was. So there's this pervasive view in trading that you have to be sort of cool as a cucumber, Zen-like meditation master to be a trader, that you should never get excited when you win or annoyed when you lose. And I've seen absolutely no evidence that that is the case. Now, I know prop traders that regularly break keyboards, but I've never personally, on my own, I've never ever seen the point of taking my anger out on a piece of computer hardware. It just seems like an abstract thing to do to me. So for many people, trading can be an emotional game. And I've not seen any evidence that you can or that you need to switch this off. Now, what is interesting about the angry guy was that even in his anger, he saw no upside in taking that emotion to his trading, right? You would think that someone that rants like that, or someone that smashes a keyboard at that point in time, you would think that person has totally lost control, right? But it seems that successful but emotional traders haven't taken the emotion out of what they're doing. They just simply don't channel their reaction back into trading. Now, I can't prove cause and effect here, right? But it seems like a very big coincidence to me that a lot of the successful traders I know trade a style that appears to match their personality, right? So if you look at people like John Grady, he trades treasuries and they're very slow, and he's a very calm, placid guy. I know people that trade crude and they're very energetic. They've got a low boredom threshold. Now, a lot of prop screen traders that you meet nowadays, if you meet like prop traders or screen traders, younger guys, not guys that are still doing it, that are a little bit older, they tend to be a little bit nerdy, right? Or rather that you get this impression that like these guys are going to be like the Wolf of Wall Street, and they're not. They're not jocks. They're not alpha males. You may have kicked sand in one of their faces in a trip to the beach. But like I said, this is hard to prove either way, but it is noticeable that as you talk to different people in the industry, how successful traders seem to be trading their soulmate market, right? Take somebody who loves math, they're in options. Take somebody who's really chilled out, they're in treasuries, trading spreads, that kind of thing. Now that's good because you can't actually change your personality, right? So it's good that people with different personalities seem to have settled on a market that matches their personality. So if that personality is something you can't change, what you can change is the baggage that you bring to trading, right? That is something that you do have control over. Now, we talk about baggage. It could cover a lot of different things. It could be emotional baggage. It could be stuff that you did before that you bring to trading. It's not all negative, right? There's positive and negative baggage in trading. And it's up to you what extent you let these things impact your decision making. Now, one of the unfortunate things is the majority of traders, and I would say 90-95% of the trades I meet, come from a middle class background. I have met very few successful traders that grew up in an environment where money was scarce, right? Now, I've discussed this with people like psychologists, NLP practitioners, and there's kind of a general feeling in that industry, NLP, psychologists, that many people hit a ceiling in their success, not just in trading, but in life in general, because they feel they don't actually deserve it. It's like a self-imposed glass ceiling that, you know, putting in effort to trading that has such huge rewards is actually not something they deserve. So what you'll see is you'll see that people go through the motions, but as they're going through the motions of trading, they actually self-sabotage, right? They appear to do things that they know will not progress them. So it doesn't mean they lose trades on purpose. It's just that subconsciously they know the right path and the wrong path, and they choose the path least likely to succeed. And it's certainly an explanation for a lot of the irrational behavior you see in traders. So if you think about it, if you grow up in a middle class family, you tend to be growing up around more wealth. So the ceiling for somebody like that in terms of what they feel they deserve is simply higher than somebody whose parents had to struggle to put food on the table. You know, people who, you know, when they were growing up, the parents would constantly say, you know, do you think money grows on trees? That kind of thing. So the simple fact that some people grew up in an environment where money was scarce does actually seem to hold them back. Now, another thing that seems to impact people is their hobbies, bizarrely. And it's just basically what kind of things did you do when you were growing up? Were you in the soccer team? Were you on the running squad? Did you play a musical instrument? Did you play chess competitively? If you did, then proprietary trading firms looking for interns would choose you over somebody that didn't, because they feel you have a higher rate of success, because you've done those things. And when I say success, I actually put an emphasis on the suck part of that word, because for everybody that's ever played an instrument as a child, you will know that you sounded absolutely awful on day one, and you probably still did at the end of the third month. And it's not really until like a year in that you started to be rewarded with some sweet sounding music. And that's pretty much trading in a nutshell, right? You're going to be terrible at it for a year at least. You're going to suck. You repeat that, you suck some more, you repeat again, and then eventually over time you stop sucking. Okay, so what some traders do with like constantly switching techniques, it's the equivalent of saying, right, I'm gonna play piano this week, I'm gonna switch to violin next week. Week after that, I'm gonna switch to saxophone, and keep doing that. And then at the end of 52 weeks, expect that you're gonna end up being a musician, right? It just doesn't happen. So for many successful people, that's a key factor. For other successful people, really successful people, even with those things, they ended up in a career before trading that actually holds them back, right? So if you don't know this, I can tell you this, proprietary trading firms would much prefer to take somebody straight from school than to take somebody that's already got some industry experience. So they like traders young and without any bad habits, because for many people, especially those that are on the high end of the IQ scale, they find it very hard to shake off their career experience. So I'll give you a couple of examples. Pilots are among the worst offenders at this. They are amongst the worst traders. So a pilot will come into trading. Almost every pilot I've ever spoke to that comes into trading, what do they want? Well, first of all, you've got to remember, pilots consider themselves very accomplished. And I do. I consider somebody that's an airline pilot for a living as somebody who's very accomplished. And they do too. And I think there's nothing wrong with that, right? But they come to trading. What do they want? They want a dashboard. They want a cockpit of instrumentation that tells them at a glance where all the key metrics are. So they often spend their time looking for that right combination of dials and knobs and instruments, and end up with screens full of stuff which may well help you fly a plane, but don't actually help you in trading. So they actually go down intentionally down the path of analysis paralysis, right? So they think cockpits work in a plane, cockpits must work in trading. And effectively what they're doing is they're getting into a comfort zone, right? They're not really saying cockpits must work in trading. They're really comfortable with cockpits. They're comfortable looking at a lot of instruments, right? They're not comfortable making a life and death decision based on like 2 data points, right? That's way outside of their comfort zone. So because there's money on the line, there's pressure involved in that. When they're in the heat of the moment, you know, it's a pressure situation, just like flying a plane through a storm, I imagine is. They're in that pressure situation. What do they have? They got 1 or 2 instruments. They got the price. They got maybe the order flow. And that's not natural to them. They've gone through a career training that teaches them the opposite of that. Then nerds, another group of people that's terrible at trading. And if you're one of these things, it doesn't mean you're going to be terrible at trading. It just means that generally their career negatively affects them. But nerds, and especially programmers, right? They try to find a solution to trading as if it was a Sudoku puzzle, because that's what they do at work. That's how they see the world around them. They see that trading has numbers, prices, volumes, bids, offers. So they presume that they can crunch those numbers with some magic formula and break the code. So they decide the approach they take to solve problems at work will solve the problem of trading. And again, it's really kind of a little bit of hubris of thinking that trading will actually bend itself to your career skills. So the best way to wrap your head around this as a successful person, whether it's a senior manager, a pilot, an engineer, a business owner, whether you're a florist or a baker, right now, if you look around your industry, how many people in your industry have been approached by proprietary trading firms? Right, just go and ask yourself. If your industry, if your airline industry was consistently pushing out great prop traders, right, the prop traders would be recruiting in that industry. And I would say if you're in your industry, you haven't heard of anybody being approached by a bank or a prop firm, there's probably a reason for that, right? They would recruit in your industry if your career skills were a big factor of success. But instead, they prefer a blank slate. So if you're a pilot and headhunters aren't calling you up trying to give you a trading job, it's probably because the proprietary trading firms don't think those particular skills are transferable. It doesn't mean you can't be a trader. It just means you don't really want to bring those skills to the table. Now, it's one of those things, though. It would be fantastic if this was right. If you spent 15, 20 years in a career, if you spent years stacking shelves in Safeway and that put you on the path to be a successful trader, it would be fantastic. But my observations are that the less you try and bring to the table as a trader, the higher your chance of success. So I work with traders, and one of the things that I do quite often is to tell them, look, let's just put that to one side. Let's just bring it back later. People don't want to let it go, but if you say, let's bring it back later, it's easier for people to kind of move forward without those things. Now, intellect is an interesting thing. Do you have to be clever to trade? And I think with this, it all depends on what you mean by clever. So what you term as IQ, we usually are referring to analytical intelligence. And that is definitely a factor in success. But obviously, I can't go around giving people IQ tests, right? So we make a judgment on how intelligent we think people are. So I can't give you the IQ of the traders I've met. But what does stand out is the different blend of types of intelligence. So I've already said the people that work in options are generally more mathematically gifted, right? They're high in analytical intelligence. But if you look at the earlier example, the guy who's running an open outcry desk and basically convincing major banks that there's a queue around the street for currency, that's basically charm and street smarts, right? That is practical intelligence. Now, if you've ever worked in IT, as I did many moons ago, you've likely come across people that are very, very high in analytical intelligence, but very, very low on common sense. So I used to work in research and development, and part of research and development is you're doing stuff that nobody's ever done before. But part of running a business is you still need to allocate cost, right? You can't just do stuff and say, we might work on this forever. So I worked in R&D, and we'd be in meetings, and some of the really, really smart people in R&D, you'd say, okay, how long's your part going to take? And there was one guy who just consistently would say things like, it'll be somewhere between 48 hours and 6 months. And it's impossible that the scale could be that range, but it was just the way his head was wired. The guy had no practical intelligence, right? It was really high IQ, very clever, but low on practical intelligence. So people like that are absolutely fantastic in IT. You would never put them in front of a customer. And those people are not hard to spot, right? You know when you meet one. I've never seen one that had made it in trading, but I do know traders that employ quants that are like that. They do risk modeling, they do risk management, they do modeling of new strategies. They just don't do the actual execution. Now, one of the up-and-coming retail traders I'm working with at the moment is a guy that sells second-hand cars. And the process of that, he explained to me basically what he does. He buys the cars at auction, he takes them back to the shop, gets them inspected. They've got like a team of engineers. Some of them fail, go back to the auction. The rest go on the lot, and after a spit and shine. And then there's him and a team that have to convince people the cars are a good deal. Then they've got to negotiate them, try and upsell them a warranty. Now, in doing so, he has to pay his staff's wages, he has to pay the commissions, he has to pay the rent, he has to pay for repairs, he has to implement staff bonus plans, and at the end of the month, he has to make a profit. Now, if you think about the things he has to do, he's obviously got a mixture of practical, creative, and analytical intelligence, but he is not Stephen Hawking, right? This guy isn't a boffin, he's not like a scientist, but he started trading a year ago, and he's already considering selling his business. So it's good combination. Now, one trader I met this week, I'll just talk about this briefly, it scaled into a position when the market was going sideways, right? So he's doing a strategy where he scales in, and the market was moving sideways, and he scaled into the market. He got in at one price on the S&P, and he got in some more contracts a tick below, and he got in some more contracts a tick above, right? So it was basically the same price, and he ended up long 5 contracts, right? And they said to me, look, I have a really hard time telling where the market's going to go when it grinds sideways like that. And of course, the answer to that was, you know, at that point, nobody's got any idea where the market's going. That's why it's grinding sideways. So, you know, better to scale in as it moves away. And again, it's developing that kind of practical intelligence, right? Market's moving sideways. I need to decide what it's going to do. How do I do that? And the answer is use some street smarts and understand it's moving sideways because nobody knows, and kind of live with the fact that nobody knows, right? So it is difficult to gauge somebody's intellect, but if you look at the abilities most accomplished traders have, it's the ability to see new patterns and trade them. That's kind of a creative skill. It's being able to adjust your technique to current news events. That's more street smarts, right? Knowing this has happened in the news, therefore I think the market's going to react this way. And traders I meet, they seem to have skills, good level of intelligence across the board. But I'll also say I don't spend time in the HFT world. I know very, very few people with a foot in that world, where I'm sure the balance of skills is going to be definitely different. So if you can understand where you fit into this, you know, whether you're high in analytical, creative intelligence, then you can play your strengths just as you can with personality. So like I say, options is a very good example. If you're high in analytical intelligence and math, then you might want to go towards options. Now, the other thing that seems to impact traders is time. And very few people become an instant success of trading. Even at prop firms, it's the rare trader that gets a live account after like 3-4 months. Very rare. Now, I recently received an email from someone, and he works 2 weeks on, 2 weeks off. So he's got 2 weeks out of every 4 weeks to trade full time. And he said to me, look, should I use market replay in the evenings of the days he's at work, and trade market replay? And to me, that's an absolute no. Because first of all, if he can spend 2 weeks full time on the markets, he already has way more screen time than most employed people anyway. So he's ahead of the game in that respect. But like many, he's really focused on elapsed time or total time spent versus quality time. So trading on replay, if it's all you have, fair enough. But in terms of the quality, replay is not quality time compared to being at live market. So if you think about it, in a live scenario, you sit down in the morning, you look over the news, you figure out what's impacting the market. You can look at what happened overnight, and then ding, ding, market opens, and you can start to move with that market. If you compare that to market replay after work, you're tired. The news has already happened. So you're not going to hear some news over the squawk that's then going to be reflected in the market. Replay doesn't really move the same. It's kind of lower quality time. And it's rare to meet a retail trader that isn't willing to work hard, measured by the amount of time spent, right? Almost all people that get into trading put a lot of hours in. At the same time, though, it's extremely rare to meet a retail trader that will only focus on effective tasks. So a lot of people are acting almost as if trading is a drug or a game of Space Invaders. They're really kind of addicted to it, watching the markets all of their spare time, trawling YouTube all the time, reading trading books, always kind of trying to suck up information on how to trade. There was one guy in one forum, and he would keep his trading PC next to his bed, and if he woke up at night to go to the toilet, he would check his screens. So wake up in the night to go for a pee, check his trading screens. Absolutely normal to him, right? And people like that, they're basically generally at the high end in terms of elapsed time or time spent looking at the market, but the low end of actual effective time. So if you go to a prop firm, one of the big benefits of a prop firm, forget the training, forget being around other traders. One of the biggest benefits of working in a proprietary trading firm is they will kick you out if you don't do what you're told. Right? It's one of the biggest things that you don't have at home. You don't have anyone saying, close Facebook or stop changing techniques, right? So they will kick you out eventually if you're not focused on effective tasks. And these are, this is my version of what I've seen to be effective. And it really shouldn't surprise anybody. Most traders do actually understand this conceptually, but they don't execute along those lines. So the vast majority of retail traders focus on these top 4 activities. And only one of those activities is really effective in any way. But they lose that effect because they keep changing methods all the time and they don't perform, some of these other tasks below. So traders do put time in, but for a lot of traders, it's not effective time. And it's kind of that, you go back to this thing about imposing a glass ceiling on yourself, right? Doing things that you really know will not make you successful, okay? So this is one of the areas where traders will focus on things that they know are less effective, either because they're just having fun trading, which I think is fine, or to intentionally self-sabotage themselves. And one of the biggest benefits of being in a professional environment is that you literally have no choice over this, right? You have a boss that tells you what to do, right? So there's less freedom of choice, and it turns out that looks like it's probably a good thing. Now, right now at Axia, a very famous prop firm in London, if you didn't hear about them, they've got a guy who's 23 years old, and he's just started to put in regular $10,000 days, so $10,000 profit days. He's not profitable every day, but he's starting to get the bigger days. But he's surrounded by people that put up much bigger numbers. So that guy in that firm trading his 50 lots on crude or whatever it is, he probably still feels like one of the smaller traders compared to the big guys who can do 1,000 lots, right? On the other hand, I'm not going to name less successful prop firms, but another prop firm I'm not going to name, they've got a lot of traders struggling to trade spreads. So they've got a lot of traders that are barely breaking even after the commissions. So guess how their new traders perform, right? So their new traders come in, they see this instantly, it's that mental glass ceiling, right? So there's a correlation between being around people who are doing well, being around success, and achieving that level of success. Now, replicating that online or at home is actually really difficult. I mean, I talked to a guy a couple of days ago, 6 years in trading. I was the first person from the industry he'd spoken to in 6 years. He'd never spoken to a single trader. He'd never spoken to a single person in the industry in 6 years, right? It just boggles the mind that you spend that much time in an industry and never speak to somebody else in that industry, right? So replicating it online is difficult, right? There are people online. If you look at some of the forums, especially people with the high post counts, there are people online that are there because they need to be heard. They want to be considered an expert. They're not, but they kind of get off on that. So you have to be very careful about who you listen to. The other thing is, you can also end up getting pulled in too many directions. So there's always somebody telling you about kind of the next big thing. And regardless of whether that's true or not, even if it is the next big thing, if you keep changing your approach every time you hear that, it's almost going to guarantee your failure. But it is really good to be around other people. It's good to bounce ideas off people, to actually see what other people are doing. So in the prop firms, there are some exceptions to this. There are prop firms that do a real wide variety of techniques that are quite open to that. But in prop firms, generally, traders have associates, they have colleagues that are trading a style, generally speaking, that's very close to their own. So if you look at social media as a way to replicate that, the best way to approach it is to basically blink yourself and narrow your focus to just very specific threads, specific discussions, specific chat rooms that match what you're trying to do, and just blank the rest of it out. So communicate with people whose experiences are experiences that you want to attain or that are closely matched to what you're actually doing, and develop those relationships, and even get on the phone with people and meet up. We do the same thing at Jigsaw. We have a chat room, but it's very narrow focus. So people that go in that chat room are basically talking about one thing and not getting pulled all over the place. So if the correlation I've observed between a new trader's success and the people around them, if that is indeed real, then you want to make sure you're not in a group that lowers your expectations, right? So again, it kind of puts this glass ceiling around what you can achieve. So in my opinion, the best thing you can have is to be around people who are doing well at trading. The worst thing you can have is be around people who suck at trading and that you actually know it, and it imposes that glass ceiling. And in the middle is to just not be around people. So if you can't be around, if you can't communicate with people who appear to be doing well, who kind of raise your expectations and lift you up, you're actually probably better off not talking to people. Okay, now consistency. How do we achieve consistency? And I think the first thing you need to consider is, what does consistent trading look like? Because you've got two different things in the trading world. You've got consistent results and consistent behavior. Because from what I can see, in 90% of the traders I know that are successful, they don't have consistent results, right? Now, there are some traders I know that do very, very specific things like multi-day spread strategies that make you a tick, but like that just work over and over and over again. That kind of thing is a lot more consistent, but it's really out there, and it's kind of really more mathematically minded, and not really many people know about it or do it. But for people that trade outright positions, like most people in this room, people who buy to sell higher or sell to buy lower, the most consistent behavior, if you behave totally consistently, your results will be inconsistent. So returns on trading, they're lumpy, they're inconsistent. Again, sometimes people will send me, this is my goals. I got a spreadsheet a couple of weeks ago, very lovely spreadsheet with, this is my goal, this is how much I'm going to make this day, and then this is what I'm going to return in. And they had like this plan for scaling up. And it's, and it was based on a really consistent return. And it's like, that'll never happen. I don't know what to say, but that's not going to happen. So, this idea where you say, right, I'm going to make $1,000 every day. Okay, it's not possible, right? You might average 1,000 a day, but there is no method that will yield $1,000 every day, simply because the market is not consistent in the opportunities it makes available every day. So consistent trading will not yield consistent results. But in a prop firm, trading outright positions, when they have a newer trader on, the first thing they want him to do, or the first goal they give him, is to achieve consistent results, which kind of seems a bit counterintuitive, right? Because we've already said that's not possible. So a newer prop trader is going to be focused on consistent behavior, a fairly narrow range of techniques. When a prop trader grows up and kind of becomes more self-sufficient, they trade a lot of different styles. But generally speaking, they'll start off with a narrow range of techniques, narrow range of setups, and a marginal profit, right? So like a few $200-300 a day is the goal, right? And they've also got a max drawdown. And if they exceed that max drawdown, they get put back on simulator. That's smart, right? But it's also totally unrealistic, right? Because that maximum drawdown is a static limit in a variable market. So what do the smart prop firms do? Well, on days when the market is particularly bad, they will actually allow a larger drawdown. They're not going to tell the trader this in advance, right? So you might see a trader at the end of the day, he's below his max drawdown and he thinks he's going back to sim. But if the conditions are exceptional, management say, you know what, that was a really crappy day. Nobody did well. We'll allow you to continue live, right? And that brings you back to practical intelligence. That set of rules, that kind of acknowledgement that, the market was a bit different today, is just a display of practical intelligence on the part of the firm, right? They give limits, but they're flexible because the markets are so inconsistent. So you have rules to stick to, but when something happens that's beyond your control, they're going to be more forgiving, okay? Now that covers the exceptional loss side, but there is a flip side to that, and it's a really important flip side, right? As traders progress, one of the steps that's really important in a trader's progression is to make more money when there is more opportunity. So this doesn't mean using a different approach. It's more a case of just adjusting your size when conditions are favorable, right? And also a lot of it is to be more aware of kind of what's going on around you in the market, like especially news-wise, that actually might mean that the markets will be more volatile, okay? So if you're consistent in the long term, it's really more about consistently taking the opportunity that is available, right? And that will obviously lead to inconsistent returns, which should mean big days when there's more available. So if you're making $200 a day and doing exactly the same when the S&P drops 200 points, you are not making the most of the opportunity available, right? You're still at risk of washing out, of blowing up. So those big days allow you to lose bigger on smaller days, right? It takes the pressure off you, it allows you to have a lower in rate, it's a cushion. So the ability to trade larger when there's more available is kind of key to long-term success in a prop firm, trading outright positions. So you might go in a firm and you've been there a year and you're churning out your 200 or 300 days profit. Management are looking at you and probably thinking, you know, he might make it, he might not. You know, he's doing that. Once they see that you can kind of step up, you know, from just that kind of, you know, just keeping your head above water to really starting to push it when the opportunity's there, that's when they think you're a career guy. That's when people think, you know, the longevity is there when you can do that. Now, a few more things before we come back and tie a bow around these topics. Obviously, with things that make you successful or things that you should achieve, that's great. There are some very, very common things that kill traders. Most traders know about these stuff, but they do them anyway. Now, a few years ago, I was in touch with an aspiring trader, and I helped him in a very, very small way to get into a prop firm. And the help I gave him was simply helping him with his application letter, which, to be honest, was brilliant anyway. Now, he started out with about $35,000 in savings. He got into a London prop firm, and they were paying him about $700 a month stipend in London, right? That's basically just about enough money to starve on, right? They don't pay a salary, but they pay this kind of, it's like a stipend. It's like, I don't know, it's like expenses. So this trader was in a prop firm, but he was also leaning on his life savings, right? And he went through the training program, then he went onto the trading floor, where basically he had to prove himself on sim. Now, we used to have a Skype group, and he'd come in every day, tell us what he was doing. It was really interesting just for everybody to just hear what he was doing every day through the training and beyond. And what he was doing was changing his approach every day in a prop firm. So every day there was a chorus of us on Skype saying, dude, just do what they tell you to do. But no, he had an indicator here, a footprint there. And it was basically a typical case of self-sabotage. So he got to 6 months with the firm, 3-month training program, 3 months on sim. And at that point, they stopped the $700 a month. But they kept on paying his desk fees, right? So they're basically saying, look, we can't pay you anymore. You've got to try and make it on your own. We'll still pay you desk fees. And then, you know, it was about 2 months into this, after we're 8 months overall. And one Friday, I can't remember what triggered it, but the Skype chat blew up. And it was like, you know, people saying, look, this has to stop. You keep changing things. You have to just buckle down and follow what they tell you. Because we really like this guy. He's a really nice guy. And we were a bunch of concerned citizens. So finally, on that Friday, everybody stopped trading. We were an hour talking to him, and we convinced him. We convinced him to stop changing what he was doing and just buckle down and just make sure and just track his improvement. That was the Friday. On the Monday, first thing he did when he came into the chat, he put a screenshot of his new chart layouts. And at that point, it went crazy, right? And it was like just Friday, we'd had this heart-to-heart. You said you weren't going to change anything. And he says, yeah, but I've just changed my charts, you know, and anything like that, that is the definition of changing something. That is the definition of changing something. You're changing the information on which you make a decision. Anyway, the guy stayed there 12 months. The firm was very patient with him. 12 months, the savings were gone, his dream was busted, and he went back to work, which was actually good because there are retail traders that have been doing this for 15 years, right? And they won't quit. But there's nothing that makes them quit, right? Because they're doing it part-time. Actually allows you to self-sabotage yourself forever. So that changing techniques is one of the biggest things that I see as being the most common killer. The other one is sunk cost fallacy. The inability to stop using a certain thing because even though it's not helping, you've put so much time and maybe money committed to that set of techniques that you can't stop. So people saying, you know, I can't stop using moon phases in trading. I've spent too much time on it, right? It's a big killer for traders. Then greener grass. The idea that somebody else's technique is easier. Now, I can hand on heart tell you that what I do personally as a trader is not difficult. It's not difficult now for me. I can explain it in 10, 15 minutes. But when I'm explaining it, and when anyone is explaining their techniques, I don't explain the cost of getting to that point. I don't explain the frustration in making it work for me. I don't explain why I kept taking off planned trades. I don't explain looking in the mirror and calling myself an idiot. I don't explain my wife coming into the office saying, you okay? Who are you shouting at? So when you're at the stage while things are extremely tough, it's natural to think the cause of that toughness is your method, right? That you've just chosen a particularly hard method, where somebody else isn't, because they're not crying their eyes out when they tell you how they trade. So hence the grass always appears greener. So the bottom line is, as traders, is you have to accept there literally is no easy method, right? We've all got to work through a number of issues and an amount of pain to reach our goals. And if you keep switching because somebody's looks easier, you're just kind of giving yourself more pain and resetting. Now, gambler's ruin. One of the recurring themes on internet forums is about whether trading gambling. You see it comes around every year or so on the trading forums. And I think it's an interesting question. And I can understand both sides of the argument, the people that think it is and the people that think it isn't. But after years of working with traders, I think the question that people should be asking is, which form of gambling does trading most resemble? So I'll give you 3 examples: slot machines, blackjack, and poker. Now, just to be open with you, I'm a terrible gambler, right? So before I came to trading, if I went into a casino, I would be quite happy to play a slot machine. I would be quite happy to play blackjack. I would not go near a poker table, because my gut feel was that my inexperience would mean the other poker players would take my money off me, okay? And I'm supposed to be smart, right? I'm supposed to be reasonably clever. But I would look at poker, a game of skill, as something I could never win. And I would look at the other 2 games, slot machines and blackjack, and I'd look at those where I was mathematically guaranteed to lose. I would think they were safer, right? Now, if you compare these games to trading, slot machines are equivalent to the kind of new, uneducated trader that just buys a system, with the flashing lights that guarantees to make money for him. So that's a trader, goes out, buys a mechanical system, doesn't care why it works, hasn't done the math, doesn't really want to do any work, and he's not even thinking about the price of that system relative to the value of that system relative to the price he's buying it. So he follows it, he loses money until either he doesn't have any more coins to put into the market, and he bombs out, or he becomes a bit more savvy. The blackjack player is a little bit more savvy, right? So the blackjack equivalent of trading is somebody, if you think about blackjack, there's a few rules to learn for a start. There's insurance, stand or hit, splitting. You can improve your odds by following certain rules. You can improve your odds by cheating, right? What you can't do is win, right? If you follow the house rules, you cannot win at blackjack. Right, the equivalent of trading is somebody that kind of has their act together, understands what moves the market, but is forging ahead, trading something without really understanding if it will win or lose over time. And the reason it's similar to blackjack is that the trader is basically ultimately at the point where they click buy and sell. They're playing based on hope. There is a hope that they will win. They know they haven't done the requisite work to understand the probability of whether they will win, but it's a hope. So there's lots of people that trade live. There's lots of traders that lose. There's very few traders that can tell you, I meet traders, typically they will say, I've been doing this for 5 years. And I'll say, what techniques have you tried? I say, all of them. And I'll say, okay, which ones worked? None of them, right? So there's very few traders that can say, this technique here that I tried for 3 months, it looked like it should show a 2.5 profit factor, but I could only got 1.2 when I took it live. Okay, but you should know that, right? The poker players of trading, and I mean good poker players, these are the guys that understand the game and the approximate odds of winning. And this is one of the things I see repeated time and time again with traders that make it. They are just as keen to press buy and sell as anyone else. They just have a slightly higher information threshold. They want to have an idea of whether it will work before they commit money. It's not a guarantee they're after. Doesn't take a PhD in statistics. It's just one additional layer of questions that they want answered before they commit real money. And that is, they want to know, is this actually likely to work? Now, another way to think about this, 95% of my customers are men. And my opinion is that a good way for a married man to decide whether to put money into the market, real money, is to get their life partner or wife to review that decision. Okay? So if you think about what that does, it raises the information threshold. Most men hate the idea because most men love that kind of blackjack stage of trading. Oh, I picked a technique, let's trade it low, right? They love their spare time kind of playing buy and sell Space Invaders. Another way to think about it, let's say you have a friend that's sim trading. He says he's ready to trade. He says, look, I'm ready to trade. I'm doing well on sim. I need you to give me $50,000. What do you need from him to give you the confidence to give him the money? The information threshold just went up again, right? In other words, traders will happily play blackjack with no edge with their own money, setting a low information threshold for their trading. But when it comes to giving somebody else money for trade, they have much higher standards. Now, of course, many traders do actually get better with that blackjack approach. We're just going in and clicking buy and sell, but it's a very low percentage. What you tend to see, somebody will pick a method, and it's kind of a blackjack approach. I'll just pick the method. I don't really know if it'll work, and the account swings up and the account swings down. It goes this way and that, and it's not doing any real damage. So what they get used to seeing a loss on the account, and they get used to recovering. But it's not really their skill that's recovering the loss. It's just a zero-edge system that's swinging up and down, right? It's just randomness. And for some, that is actually the worst thing that can happen, okay? Because it leads to the true gambler's ruin, which is trying to win the money back. And that's the end game for a lot of traders. So it's no edge, pure blackjack trading, but with the added confidence of seeing the account swing up and down and thinking that you've got the ability to recover. So when a black swan event occurs, something that hits you offside way more than usual, is you think you've got the skills to win it back. Which is why I'm sad to say I've met traders that have lost hundreds of thousands of dollars doing that. But I've seen traders lose their homes and lose their marriages. And it's all really from one simple flaw. It's setting the information threshold on what will allow you to trade just a little bit too low. The final thing we're going to go through, and you all know this because you've probably been told it 100 times, prop firms force their traders to review their decisions, right? So they teach skills and the traders trade. Then there is some sort of collection of what they did at the time. They make notes or whatever. It might be memory, might be written notes, might be on a system like Journalytics. Then they review it, right? They review, what did I trade? Why did I take those trades? Did I make any mistakes? What did I do well? What should I do more of? What did I do poorly? What worked? Over and over again, you hear trading psychologists like Brett Steenbarger tell us this is a massive differentiator in prop firms. Merritt Black at SMB, Alex Hayward at Axia, all of these people that spend their days working with traders that make it, say this is something that successful traders have to do. And you go to the retail world and nobody does it, right? And it's one of the most interesting aspects of observing traders, the difference between people intellectually knowing what they should do and then what they actually do. So the review is the single most effective trader development activity. It's what allows you to suck at a technique and eventually master it while seeing your progress along the way. So when I talk to traders that are kind of that are new to me, there could be 6 years in, but there's nothing that's tracked the progress. It's basically it's 6 years of trying stuff and it's not working. That's it. That's the progression. It's not 6 years at level F and then 2 years at level D and then 3 years at level C. It's not that. It's 6 years of no progress, right? But you do as a trader need to reflect on what did and didn't work for you when it's not in the heat of the moment of managing a trade. Then you can make adjustments for the future trading sessions. So being a success isn't about finding a magic bean solution and making profit from it from day one. It's about developing your ability to apply a technique. Now, the interesting thing about all of this is that actually it's not all doom and gloom, right? So I've seen trading webinars where the presenter makes it seem like trading is just this unsurmountable task that is just so difficult that only a few people will make it. And the interpretation that most people take from that is that the activity of trading or the ability to execute or the ability to know when to enter the market is what's unsurmountable. But the way I see it is that most of the time, it's just traders getting in their own way. And it makes you realize how becoming a trader is more about removing self-imposed obstacles than having some magical piece of knowledge or particular skill set. Now, one difficult part is recognizing and getting rid of some of the baggage, right? So if you were raised, as I said earlier, if you were raised in a poorer household, right, where you are continually hearing about money's tight, money's really hard to get hold of, money doesn't grow on trees, that is something that you might need to go and talk to somebody about, get yourself out of that mindset, right? Because that can be a restraining factor. And psychologists, NLP coaches, they're used to dealing with this in people of all walks of life, right? It's not specific to trading at all. As traders, it's your job basically to decide if you actually want to succeed, right? Do you actually want to succeed at trading, or is it just a hobby, right? And if you decide it's just a hobby, I think that's absolutely fine. So if you like coming home after work and clicking buy and sell, and you may be trading, or you're not really losing any money, but you kind of like the buzz of getting involved in the game, I think that's absolutely fine. I think that's absolutely fine. As long as you're not doing any damage and you're enjoying yourself, why not, right? But just don't kid yourself that that's going to lead to you leaving your job, right? So if you're sitting there and telling yourself, you know, what a lot of people say to me, I can't stop taking off-plan trades. The simple answer to that is, yes, you can, right? You absolutely can. Everybody can stop taking off-plan trades. It's just something you need to work on. The way you work on that is review every trade. At the end of the day, you'll eventually get sick of reviewing off-plan trades. Now, if you Google losing weight online, you will find thousands and thousands of easy ways to lose weight. Fads that don't really work, and you know it, right? Everybody that sees these things know they're going to see a bunch of fads, and even the people that buy those fad diets, they know they're not going to lose any weight, right? But it just feels like action, right? So you know what? If you want to lose weight, it's easy. You don't need to use Google. You just eat less and exercise more. And it's not fun, but it is what you need to do. And it's exactly the same with trading. And that ends my presentation. So do we have any questions that you'd like to type in? I think, Terry, you'll be fielding the questions, right?
Yes, sir. Hi, guys. If you have any questions, please feel free to type them in, and I'll ask them to Pete. I don't see any at the moment, but I'm gonna give them a minute to type them in.
Yeah, I've got one that says, will this recording be put on YouTube? And I think you covered that, right?
Yes, it'll be posted in 24 to 48 hours. How did you find an edge?
Basically, I talked to people in the industry, and I did a lot of research on what they were doing. I actually came into this as somebody who's technical. I actually came into this, and I tried to program my way to a solution. And you know, I was talking to other traders, but I couldn't get out of that mentality where I wanted to bring more life skills to trading. So that was a big mistake for me. And what happened was I reached about 6 months in, and I realized I wasn't getting anywhere. So I just talked to different people. I talked to a few educators and a few traders, and I just tried to replicate what they did. I actually first, the trader that was doing the stocks in play trading, I actually tried to do that first, but I just found that without the researchers and without the, you know, without spending a lot of time before the day, what I'd find was I'd see that stocks were in play, but by the time I actually bought them up, by the time the market opened, 50% of the stocks had already moved in the pre-market. And then, you know, so then you'd use scanners, and a lot of times things would come off of scanners. I just found it too busy. And that's basically when I discovered the futures markets, and somebody pointed me towards the futures markets. And really, finding the edge, it was mostly just trying to replicate what other people were doing. So the first attempt failed. I knew it was a valid technique, but I just couldn't either get my head around it because it wasn't, I just didn't have the time to do the amount of research required, or I just wasn't very good at stock trading. I'm not really sure. But it was just the second set of techniques, which was basically people saying, just try and go with the market, like just try and go with the market and try and develop those skills, and then try and understand how to manage those trades, try and get a decent risk reward ratio. So really the start of it was just trying to jump on momentum moves. And it was just based on what somebody else was telling me. So I had two full starts, one programming, one on stocks, and it was the futures that really helped. But it was just replicating what other people were doing that were already doing it.
Okay. This kind of ties in with that, but what kind of initial trader's education is worth the time and money?
Initial education. I found books to be of little use. I mean, I like everybody else, I spent a lot of time in Barnes and Noble looking at books. I think there's some quality stuff. I mean, the stuff at Axia to me is quality because it's from a prop firm. But I think the biggest thing that you can do in education, the biggest flaw in trading education is that a lot of it's focused around trying to guess where the low of the day will be, or trying to guess where the low of a move will be, and buying it. And I think that's the biggest failing. Prop traders don't do that. So prop traders will see a move start to move, and they don't say, there's no concept of it's too late. They'll see something move, they'll start to get into it, and they'll keep layering in. So I think if you're looking for good trading education, you want trading education that will actually be focused on things that proprietary firms are doing, which is basically getting into moves that are already underway, and also look trading education that doesn't talk about high win rates. So if you look at most prop traders, the win rates are about 50%, but they go bigger when it moves their way, and they look for a risk reward skew. So I haven't done like a comprehensive review of all education, but I know from my experience, the stuff out there that everybody that comes to me is trying to buy the low of the day and trying to get 20 points. And it's basically a sales pitch, because they know you don't have that much capital. So they know that you need to get a really high percentage return every day. So if you've got an educator who says, look, I'm going to teach you, you're not going to make huge amount of ticks every day. We're going to mostly stay with the market, the direction the market's going in, and try and make money from that. And we're not going to go for a really high win rate. We're actually going to go for a skewed risk reward. I think if you've got an educator that's along those lines, then I would be interested in somebody like that. And also, I'm a very big proponent of order flow, and there's no secret about that. So I think personally there has to be an order flow component, but that's what I do. So it's really difficult to say whether that's mandatory or not.
Okay. How do you suggest raising the information threshold for discretionary traders when the overall strategy isn't mechanical and easy to backtest?
Yeah, I mean, what I do with traders, I actually tell them to stop trading for a few weeks. So one of the things is it's always a challenge, because of that inconsistent opportunity, the volatility is always scaling up and down, right? So one of your baseline things is always being news aware and being aware of the volatility before every day. But what I do is I say to people, right, 2 weeks, stop trading and just observe the setups. And some people just refuse to do it, right? But if you can observe that when you're in a trade, even if it's a sim trade, you immediately have a bias to the outcome, and your whole head is skewed one way. If you can just say, right, I'm going to take a step back, and if it's a technique that gives you 3 or 4 trades a day, you can take a couple of weeks and just say, right, I'm going to watch this setup, and it might be better if you take 2 or 3 setups or 4 setups. I'm going to watch the setups, and I'm going to actually see how they lay up, what sort of price I might be able to get if I'm, if I did get in, and what the reaction of the market was, up or down. And you go in doing that from a completely neutral perspective, right? If you can do that, and at the end of 2 weeks, you've basically got some information in front of you that says, if I do this, then, approximately these are the results. Now, if you've done that for 2 weeks, you'll actually be able to carry that on when you're sim trading. But you do need to get out of the sim mode before you can do that, because obviously one of the things is, if you're in a sim trade and it goes your way, there's a couple of things, or sim trade and it goes against you, there's a couple of things you do naturally. Is one, you don't focus as intently on the market going against you, because you want the market to go the other way. And then secondly, you tend to do things like, holding it for too long, or being optimistic about, where it, what might happen. So if you can put those two things to one side and say, right, I'm just going to observe now, I'm going to watch every time this happens, I'm going to watch what the reaction is in the market and just make a log of that. And doing that, you can say, yeah, that has merit, or no, it doesn't. And then you can take that to sim trading. And the idea is, once you go to sim trading, you carry on that documentation. And that documentation is not hard to do. It's just writing stuff down. Should give you like a theoretical maximum win rate, a theoretical maximum profit. And then you can compare that with your actual trading results, which will suck relative to the potential. So that information threshold is giving you the potential for the trade. Your actual execution just tells you where you are on the scale right now.
Okay. let's see. How can I wean myself off all the indicators I've overspent on? Fewer charts, simpler basic, or naked charts. Stay on one market.
Um, well, I think if you take a step back and think about, you know, we've all had days like when you start out, it's actually possible, and it's not that difficult to have like have a day when you take 20 trades and like 18 losers, right? Now, the reality of that is that tends to happen in a choppy market when you chase, right? So the key thing to remember about these markets, they literally can only go in two directions. They can only go up and down, right? So all of this stuff that you're using to say if a market's going to go up or down, it's really overkill for what you're trying to do, right? So it's a kind of a mental challenge to say, right, if the market can go up and down, that's one data point. The second data point is if you need to be able to make a consistent decision, you need to narrow down the amount of things that you look at, right? So usually if you do something like learn to ride a bicycle, right? When you first learn to ride a bicycle, you're very conscious and mechanical about it. But there's not that many things to do. You've got your hands on the handlebars, you got your feet on the pedals, right? After a while, that becomes an automatic skill. And it's the same with trading. So what you need to do is you need to understand market can only go up and down. You need to stick to enough decision-making points that you can actually do something consistently, right? If you have 50 different things that you have to tick off before you make a decision, there is no way you'll do that consistently. Sometimes you will forget one, sometimes and that kind of thing. So the second thing is having enough things that you can actually act consistently, and then understand that if you do that, and you'll actually bring in that kind of automatic skill, that automatic riding a bicycle skill, where some of that analysis work is done subconsciously. You recognize the patterns subconsciously before you're doing it intentionally. So that's why I would wean myself off. Excuse me.
Okay. Do you find trade execution or trade management to take more skill or time to master?
That's a very good question. I'm not really sure, to be honest, because they both take time. What I do know is you can't get both right at once. So really, when I talk to traders, the first thing we focused on is the entries, and we're not focused so much on how much they get out of it. But once we can actually get them to the point where they can, be consistent in their entries. I have one girl, and it's a real shame. We kept trying to go around in circles, and she's trading crude, and I'm getting her to write down, how much did crude move after you got in, and it's always 5, 6, 3, and she can't. At the moment, she can't visualize, the big move, the big continuations on crude. But if you work on your entries, then the next thing you're going to either have you keep closing your trades too early, which is just something you have to observe and keep working on. And generally speaking, what I do with people is I get them to write down, okay, how many ticks did you take? How many ticks did it go? Right, I took 5, it moved 30. And what it usually is, I took 5, it moved 8. I took 5, it moved 9. I took 5, it moved 5. I took 5, it took 40. And so there's two things to that. Is trying to get the few extra ticks is one thing, and then trying to get the runners is a slightly different skill. And both skills you have to work on. And then the other one is obviously I'm letting them run against me and I'm not getting out. And again, that's a different problem. And different people have different problems. And again, it's just a matter of working through. I think the entry part's easiest, to be honest. But people do spend a lot of time trying to get an entry because they keep changing. But once somebody's settled on something, it does take months to actually to weed that out. I mean, one of the examples I gave you was a guy. He was in a trade. It was the right trade, but the market was moving sideways, and he still scaled in. Right now, we're on a scaling strategy to make more when the market goes his way, but he still scaled in. And that's just a problem he's going to have to fix. It's not the typical trade management problem, right? But it's just something he's doing. So part of it is recognizing that there are different trade management issues and actually focusing on those. So I think in time elapsed, really hard to tell.
Okay. What do you do when you know your strategy is solid, yet the market conditions seem to change from time to time enough so that it renders the strategy seemingly null and void?
You say welcome to trading. Generally speaking, a lot of strategies are adjustable with volatility. But the other thing to remember is that when you have a particular strategy that works, some of the strategies are market specific, right? Obviously, about news events and stuff like that. But when you have a strategy that works, you're generally trading a particular volatility profile. So, like in the summertime, what I tell people who are trading the S&P, in the summertime when the S&P dies, or it doesn't happen every summertime anymore. When the S&P slows down, is move to a market that is normally faster. So you might move from S&P to crude, because the conditions that you're used to trading, even though they're not in the S&P right now, they might be there in another market. So switching markets is one thing that you can do. The other thing is adjusting it to volatility. The third thing you can do is stop trading it. Make sure you understand it really well in terms of what the technique is, when it works, and then when those conditions come back, you start trading it again. What most people tend to do when the conditions change is they stop doing it, but they don't keep any documentation. They don't write. I mean, you're probably talking about a few sheets of A4 to write down what it is you were doing that was working. They don't keep that. So the volatility changes, they move on, and that thing that they were doing that's perfectly valid just slips from their mind over time, and they lose it, which is a real shame.
Okay. Oh, I just had it. Where did you go? Okay. Can you elaborate on the thought process of identifying and adjusting to an unequal opportunity?
Yeah, well, I think a lot of it is basically to be more market aware. So most of the traders I meet, they've got they've either come from technical analysis or they've come from order flow, but they don't really have any conceptual framework for, I'm expecting a big day, right? So, one of the things I do with traders, and it's kind of a bit boring, but here's what you can do. Before the day starts, right, before you start the day, have a look at the news, right? See what's in the news, right? And look at obviously you're going to look at the news, what's been out, watch CNBC or MSNBC or whatever you want to watch, or just look on the websites. Have a look what's hitting the market, look at the overnight, how it impacted the volatility. Then just write down some notes. This is what's happening in the market. These are the news events that are scheduled. I think this is going to happen. I think this is going to make crude volatile. And it's good to look at crude. It's good to look at gold. It's good to look at interest rates. It's good to look at indices. It's good to look at currencies, right? So you look at those 5 things and say, this news, I believe, is going to impact these markets in this way. So you might see some news and say, I think crude and currencies will be more volatile today, right? At the end of the day, just have a look back and see how your assessment was. You're not trying to say, I think crude's going to go up or down. You're not trying to say, I think this is going to be the high or the low. You're going to say, I think this is where the activity will be. So once you then know where the activity is going to be, and you'll get better at that over time. At the first few days, you might as well write nothing down at all because you've got no clue, right? But at the end of the day, if you just watch those markets, you don't have to trade those markets. You just watch them for how volatile were they. Just look at it, pull up a 5-minute or a 1-minute chart, daily chart, look at the range, look at what happened. Was it violent, more violent than usual? And over time doing that, you'll get an understanding of, okay, what actually hits the market. Now also listen to a news squawk while you're sitting down as well, because obviously if some news comes in intraday, like a Trump tweet, something about the China trade war, Brexit news, that kind of thing, that's going to start moving the market. And it's then you get the additional opportunity when the market starts to become more volatile. So for most people, it's just about becoming aware of the news, but also aware of how the market reacts to the news. That's really where you start to get an idea of the opportunity. And then some days you might come to your screen, there's no news, right? You look on MSNBC and the top articles about knitting, right? So there's nothing going on in the market. Overnight, Eurex didn't move at all. You should have an expectation the S&P is going to be slow. And most of the time it will be. But most people kind of skip that part of situational awareness. So if you can develop that situational awareness of what typically happens, you won't be right all the time, right? But you can say typically when there's, an oil tanker blew up in the Gulf, right? I'm expecting there a lot of activity in oil. There's an OPEC meeting. I'm expecting activity in oil. If you can like build that situational awareness, it's that gives you the ability to take the unequal opportunity.
All right, we're getting long on time, so I'm gonna make this the last question. Aside from the Jigsaw Room, how else do you recommend we network with other traders?
What I would do is I would be looking to take online conversations offline. If you're in the US, there are like trading, there are places where traders meet up as well. So what I did, I went to networking events. Now, if you're living in New York, if you're living in Chicago, then go to a networking event, and you'll find that traders are quite friendly and quite open. I certainly was, and it's partly because nobody listens to them, right? I went to a concert a few weeks ago, and I was I know the promoter of the concert. I was backstage at the concert, and there were all these music producers, and when one of them asked me what I do, I said, "There's no point telling you because you won't want to hear it." Right, and the fact is that people really aren't that interested about trading. So when you actually meet a trader, they'll tend to be quite open that you're interested. So I would say networking events are really good. If there's no networking events, and just go to a networking event in your area and just see if there's any people in that industry. But that, to me, that was the best way. And just look around for get recommendations of other people. I can recommend the Jigsaw chat, but that's just for Jigsaw customers. I don't really know what other communities there are, but I would also say you should be getting on the phone to people, right, as well. So if you do meet somebody in an online community, try and reach out to them and try and meet one-on-one, because everything you say on an online community is visible to everybody, and people might give you a slightly different feedback when you meet one-on-one. So keep the online stuff going on, but also try and meet people in reality, because you get a different impression. But it is tough. It is tough. If some of it's very location specific. Even if you're in the Midwest, where there's a lot of hedging on grains and stuff like that, then you're still going to be traders around you. So you kind of be surprised how many traders there are in every city of the world.
All right, I'm going to take the opportunity to plug futures.io is also a great resource to network as well.
Absolutely.
Thank you for the information, the webinar, for spending some time this evening, Pete, or early morning for you.
Yeah. No problem, and thanks for having me, Terry.
Absolutely. Thank you.